Somewhere in America right now, there's a fenced-off lot holding millions of dollars in brand new RVs, not abandoned, not damaged, just parked, row after row after row. Units that cost $60, $80, even well over $100,000, sitting under the same sun that's quietly eroding their value every single day. The engines have barely been started. The interiors still smell new. Yet every sunrise makes them worth a little less than they were yesterday. So here's the question almost nobody inside the industry wants to answer out loud. Who's paying for all of them? Because those RVs aren't just sitting there waiting for buyers. They're tied to loans, dealer financing, manufacturer production costs, interest payments, insurance, storage expenses. Every day they remain unsold. Someone, somewhere, is writing another check. And that's why what you're looking at isn't just excess inventory. It's the visible symptom of one of the biggest financial corrections the American RV industry has faced in decades. 5 years ago, this looked impossible. Factories across America were running around the clock. Dealers couldn't keep inventory on their lots. Customers were placing deposits months before their RVs even rolled off the assembly line. Waiting lists stretched for weeks. In some markets, buyers willingly paid thousands above sticker price simply because they were afraid the next unit would already be gone. It felt like an industry that had finally discovered unlimited demand. But demand wasn't unlimited. It was borrowed from the future, and what the manufacturers didn't realize was just how quickly that future would catch up to them. According to public industry shipment data, the explosive boom that peaked during the pandemic has since reversed dramatically. Production has slowed, dealer orders have cooled, inventory has climbed. Manufacturers that once raced to expand capacity are now trying to figure out how to manage a market that looks completely different from the one they built their business around just a few years ago. The question is, how did an industry go from selling almost everything it could build to struggling with too much inventory in such a short period of time? To find the true answer, we have to look past the factories, past the dealerships, and right into a hidden shift in the American banking system that changed the rules of ownership forever. The answer begins in 2021. America had changed almost overnight. Air travel became uncertain. International vacations disappeared. Millions of people suddenly wanted a way to travel without crowded airports, hotels, or cruise ships. The open road represented freedom, safety, and control. For the RV industry, it was the perfect storm. Manufacturers pushed production to record levels. Dealers couldn't restock fast enough. Families who had never considered owning an RV suddenly believed they couldn't afford to wait any longer. And that urgency changed everything. Because once fear of missing out enters a market, logic usually leaves. Behind the excitement, financing became easier than many buyers had ever seen. Industry analysts have noted longer loan terms, lower down payments, and faster approvals becoming increasingly common during the boom. According to several consumer finance reports, some lenders began structuring 20-year amortization schedules on these depreciating recreational assets. By stretching the debt across 2 decades, the monthly payment remained deceptively small, frequently masking the reality that the total interest cost could eventually eclipse the actual price of the vehicle. It felt surprisingly affordable, but affordability and cost are not the same thing. That's the distinction thousands of buyers wouldn't fully understand until much later. Because an RV doesn't behave like a home. It doesn't appreciate, it doesn't quietly build equity while you sleep. It begins aging the moment it leaves the dealership. Industry estimates suggest many new RVs lose a significant portion of their value early in ownership, while maintenance, insurance, storage, and financing costs continue regardless of how often they're actually used. And unlike depreciation, the monthly payment never shrinks. But here is where the mechanical math becomes truly punishing. Industry data indicates that the sharpest curve of RV depreciation occurs in the first 24 months, where a unit can lose up to 20 to 30% of its retail value, because the standard loan balance reduces in a straight line while the vehicle's value drops like a stone. First-time buyers are instantly thrust into severe negative equity. They are quite literally trapped in a race where the asset loses value faster than the bank collects the principal. Meet Tom and Linda. Not one specific couple, but a composite built from stories reported across the country. They worked for decades, paid off their home, and dreamed about spending retirement chasing mountain sunsets instead of alarm clocks. In 2021, they finally bought the RV they'd talked about since their wedding day. It felt like a reward for a lifetime of hard work. For one summer, it was everything they imagined. Then, life changed. A medical emergency kept them close to home. Campground reservations became more expensive and harder to find. Fuel prices climbed. Routine maintenance cost more than expected. Then a slide-out mechanism failed, and the repair required parts that took weeks to arrive. One setback became another, until every trip required more planning, more money, and more stress than they ever expected. The RV eventually went into storage. The loan didn't. Month after month, the payment kept arriving. Insurance premiums still had to be paid. Registration fees didn't disappear. Storage bills continued adding up. When they finally asked a dealer what the RV was worth, they discovered something thousands of owners have experienced during market corrections. The resale value had fallen far faster than the remaining loan balance. Walking away wasn't an option. Selling wasn't much better. They weren't irresponsible buyers. They simply bought during the hottest market in modern RV history. That story isn't unique anymore. Regional reporting has described storage facilities across the country filling with financed RVs that spend far more time parked than traveling. Some sit behind chain-link fences for months. Others stay in driveways, waiting for owners who hope next season will somehow make the numbers work again. It's a quiet reminder that financial pressure doesn't always look dramatic. Sometimes it just sits there, collecting dust while another payment is deducted from someone's bank account. And this is where the crisis stopped being an RV problem and became a credit market problem. When hundreds of thousands of retail buyers are simultaneously stuck underwater on long-term loans, it alters the math for the institutional banking sector. But it raises an even deeper question. If defaults are rising, why haven't we seen a massive, visible wave of repossessions flooding the market? The answer reveals a unique structural challenge within the specialized lending market. Industry analysts note that repossessing a luxury RV is often a lender's worst nightmare. Unlike a standard passenger car, which can be quickly cycled through a local wholesale auction, an underwater RV requires specialized transport, massive physical storage space, and faces a highly illiquid resale market. Because taking physical possession can mean instantly absorbing a massive five-figure loss on the balance sheet, some market observers believe financial institutions may prefer to extend terms, modify loan parameters, or delay formal default processes, allowing these units to sit where they are while trying to manage the underlying risk over a longer period. But while the financial sector plays for time, the people who actually manufacture these machines are running out of it. Now shift to the dealership side of the business. During the boom, inventory disappeared almost as fast as it arrived. Dealers placed aggressive orders because customers were waiting with deposits already in hand. Today, the conversation sounds completely different. Many dealers have told industry publications they're replacing inventory only as units sell instead of placing large speculative orders. That cautious approach protects their own cash flow, but it sends a brutal, immediate chain reaction upstream to the manufacturers. Build less. Factories cannot maintain boom-level production when dealerships stop ordering. When dealers pull back defensively to move existing inventory, assembly lines shorten, overtime disappears, and suppliers receive fewer requests for parts and materials. One decision made by a cautious buyer ripples instantly through the entire supply chain, and that is where the pressure starts squeezing manufacturers from every direction at once. Many companies entered the boom years expecting demand to remain permanent. They expanded production capacity, hired more workers, and aggressively purchased raw materials. Today, those elevated material costs remain. Imported components are vulnerable to volatile shipping disruptions, and labor expenses are higher than ever. To make matters worse, some units produced during the frantic rapid-fire pandemic expansion have generated higher warranty expenses as quality control challenges surface after delivery. Every warranty repair costs money. Every delayed repair frustrates customers, and every unhappy owner makes the next buyer a little more cautious. Lower demand, higher costs, more cautious dealers, thinner profit margins. Industry analysts have repeatedly described this as one of the most challenging operating environments manufacturers have faced since the pandemic boom ended. Public company earnings reports have echoed similar themes, warning investors about slowing retail demand, production adjustments, and continued market uncertainty. Industry experts have also noted that smaller manufacturers face unique pressures during these market downturns, as they typically have fewer financial resources to absorb prolonged slowdowns or weather the risks of significant market restructuring. For workers inside America's RV capital in northern Indiana, these headlines translate into something much more personal than an earnings report. It means reduced overtime, shorter production schedules, temporary shutdowns, and, in some reported cases, sudden layoffs linked to weaker factory orders. Behind every production statistic is a family wondering whether next month's paycheck will cover the mortgage and the groceries. But beneath the distress, an unexpected evolution is taking place. This isn't simply a story about an industry struggling. It's also a story about buyers becoming smarter. Today's shoppers are asking tough, pragmatic questions many never asked during the frenzy of 2021. How much will insurance actually cost? What happens if fuel prices rise again? Can I afford monthly storage? Would buying a well-maintained used RV make more financial sense than paying for the steep first-year depreciation on a brand new model? Those questions may not sound exciting, but they represent something the industry desperately needs. A healthier market built on realistic expectations instead of emotional impulse. Financial planners increasingly recommend viewing an RV for what it truly is, a lifestyle purchase rather than an investment. Like most vehicles, it depreciates over time and comes with ongoing ownership costs that should be part of the buying decision from day one. So, where does all of this leave the RV industry in 2026? Not at the end, but certainly at a massive turning point. The companies that adapt to changing buyers, fiercely improve product quality, control costs, and rebuild consumer trust may emerge stronger over time. Those that continue relying on boom-era expectations could face a far more difficult road ahead. For buyers, the lesson isn't to abandon the RV dream. America's highways, national parks, and campgrounds will always attract people looking for freedom and adventure. The lesson is much simpler. Know the total cost before you sign. Understand how financing works. Expect depreciation. And buy the RV that fits your financial reality, not the one emotion convinces you to own. Because the biggest mistake wasn't that Americans wanted the freedom of the open road. The biggest mistake was believing the dream itself would pay for the journey. That's the truth this industry has been slowly confronting ever since the boom ended. The next 12 months will show whether this is just a correction or the biggest reset the RV industry has seen in decades. Now it's your turn. Have you noticed overflowing RV lots or changing prices where you live? Share your experience in the comments below. And if you enjoy fact-based investigations into America's biggest industries, subscribe. Because our next documentary uncovers another story hiding in plain sight. One that proves that sometimes the most expensive things we own are the ones we can never actually use.